Hi guys, in this video we're going over chapter 7, problems 2. You can see it up here, and I'm not going to do all of the problems. Some of the problems are kind of already covered from the main video, but I'm going to do a few of them and the tax return that is included in here. I'm going to go over it line by line with you, so then you can do it on your own for the tax return assignment. All right, so determine the amount of taxable income that should be reported by a cash basis taxpayer in 2018 in each of the following independent cases. So A, a taxpayer completes 500 of accounting services in December 2018 for a client who pays for the work in January 2019. How much is income in 2018? Nothing, because they weren't paid till 2019. Now remember, this is highly dependent on the fact that this is a cash basis taxpayer, right? If they were accrual, as bigger businesses are, then they would have recorded that income in December. But with cash basis, smaller taxpayers, like individuals, they get to just follow cash basis. Okay, B, a taxpayer is in the business of renting computers on a short-term basis. On December 1, 2018, she rents a computer for $200 rental fee and receives a deposit and receives a $500 deposit. The customer returns the computer and is refunded the deposit on December 20th, 2018. So this all happens in December. She pays a rental fee and a deposit and then gets the deposit back. What is income to that business? The fees. The deposit is not recorded as income because it's going to be returned to the customer. And the business owner has to keep that deposit ready to be returned. So 200 is the rental fee is the income for 2018. C, same facts as B, except the computer is returned on January 5th. So that's the same as the first. Oh, when did they receive the cash? December of 2018, right? December 1, 2018. So that income is still in 2018. On December 18, 2018, a landlord rents an apartment for $700 per month and collects the first and last months up front. It is customary that tenants apply the security deposit to their last month's rent upon moving out. Well, that's not actually customary. That's illegal in most states. I guess they said first and last month's rent up front and not first in deposit. That's the way it is in Hawaii. There are some states that are allowed to collect deposit first and last, in which case you have a last month. I don't believe it matters that it's customary for the deposit. Let's see what they said. This is D, 1,400. So they're saying that because they collected first and last month's rent up front, it's both income. There's no deposit here. If they had said first month and deposit, that second sentence, I think, is kind of there to confuse you. But since they received income up front and it wasn't a deposit, it's income. Last one, E, an accountant agrees to perform $500 of tax services for an auto mechanic who agreed to perform repairs on the car of the accountant's wife. The mechanic's repairs in the car in December 2018, and the accountant starts and completes tax work in March of 2019. So what happens here? Since the mechanic did the work in December 2018, the mechanic includes in income the $500 of services in 2018. Since the accountant did the work in March of 2019, the accountant records income in 2019. Make sense? And other than that, it's zero in the opposite years. All right, let's go to the next question. I wanted to go through this one as well. This one is about insurance payments. There is more information in the book, but I didn't cover as much in the video. So Nancy, who is 59 years old, is the beneficiary. That means that she is going to get the results of an insurance policy. So she's the beneficiary of a $200,000 life insurance policy. What amount of the insurance proceeds is taxable under each of the following scenarios? Do not round any intermediate numbers, just hit times and round your final answer to the whole dollar. So if she receives the $200,000 proceeds as a lump payment, what amount is taxable? $200,000, right? That's easy. But let's say she receives the proceeds here at number B at the rate of $4,000 a month for 5 years. So in this case, we have to break out. I'm gonna grab my cat. Okay, so what amount of the insurance proceeds is taxable under each of the following scenarios? We covered A. B, she receives the proceeds at a rate of $4,000 a month for 5 years. So that sounds a lot different than a $200,000 life insurance policy. So we need to figure out what that total is, right? Take 4,000. First, we're getting it a month for 5 years. So that's 12 times 5 to figure out the total payments. So that's 60 payments, and then times 4,000. And that comes out to $240,000. So she's a beneficiary for $200,000. So she doesn't have to pay taxes on the $200,000, but anything over that she has to pay taxes on. And she's going to do it per year. So we need to figure out the portion per year above $200,000. So that's $40,000 in total, right? And we have 60 payments. So if we divide 40,000, that's the amount we're over the 200, right? That needs to be taxed, divided by all these payments, which was 12 times 5 is 60. So now we're going to take 40,000 divided by 60, and that's 667 when you round. And they have it right down here, I realized after I did all the math. So you can see right here, Nancy would receive $240,000 over a 5-year payment term. That's 4,000 times 5 times 12. 200,000 isn't taxable, and then she reports interest income of 40 over 5 years at a rate of 667 per month. Okay, let's go on to the next one here. So C, she receives the proceeds in monthly payments of $1,300 over her remaining life expectancy. So there are actually life expectancy tables that you look at to figure out what the life expectancy is based on the age and some other criteria, but we were just given it. So we don't have those in the book, so you're just given that we assume she'll live 25 years. So if she's getting $1,300 a month for 25 years, we'll take 1,300 times 12, 15,600 per year, and then times 25 years. So that's 390,000. That's 190,000 more than 200,000, right? Nancy would receive 390. So since 200,000 isn't taxable, only 190 would be taxable interest income. So now we need to divide that 190,000 over all of our payments. So 25 times 12 again is 300 payments versus last time we only had 60 payments. So now we take 190 divided by 300, and that's our 633. So the last one, use the information from C. If Nancy lives beyond the life expectancy, what amount is taxable each month? The full amount, because we already accounted for her 200,000 based on her life expectancy. So after that, the full amount is taxable. Okay? Okay, on to the next one. I don't think we're going to cover this one. We covered this. This is calculating taxes. You can see the answers here with my numbers. Your numbers will be different, but if you want to double check, you can calculate that. Otherwise, that was covered in the videos. So this is one I wanted to cover. This is that concept of a tax refund being taxable. So each of the following taxpayers receive a state income tax refund in 2018. The taxpayer has a filing status of married filing joint. The standard deduction in 2017 was $12,700. What amount of the refund is properly included in 2019 income? So let's say that the taxpayer in 2018 got a tax refund. You know how you get a refund of, and this is from the state, because state income taxes are deductible as an itemized deduction. And I do think that it's a little weird that we're talking about this because we haven't covered itemized deductions. But basically, the total of your itemized deductions versus your standard deduction, we've covered that. You get whichever is greater. State income taxes are part of those itemized deductions. That's all you need to understand. So if someone's itemized deductions were greater than their standard, then they got a deduction. And to the extent that they get that money back, they have to report it in income. But if putting that money into income would have made it so that they would have had the standard deduction, they only have to stop at the standard deduction amount. So these examples should help explain that. If someone gets a refund of $729 and the taxpayer did not itemize in 2017, what amount is income in 2018? Right? You file your taxes for 2017 at April 2018, or maybe you're early, maybe you're late. So you get that refund in, say, May of 2018. That's income for 2018. But if you didn't itemize, do you have to include your state tax refund in your income? No, because you didn't deduct it in 2017. You only have to include this in income to the extent you got a tax deduction from it in the year before or whatever year in question. Okay, B, a refund of $591. Taxpayer has $13,291 of itemized deductions in 2017. So this is a good one because if we subtract their itemized deductions, $13,291, if we subtract their refund, which would be taxable, right? $591, we get $12,700. So that's exactly the standard deduction amount. So in this case, the full amount is taxable. But if this amount, like in C, were to be, oh, no, it might not come out. We'll see. If this amount were to go below $12,700, if you take their itemized deductions and you subtract that refund and it brings you below the standard deduction, you don't have to go below the standard deduction when you include it in income. You only have to include down to the standard deduction amount because you could have taken the standard deduction if it was greater. So that's a good thing for the taxpayer. So let's see. C here, a refund of $927. So what happens if we include that in income? What would their itemized deductions have been? $13,000 minus $927. So now we're below the standard deduction. So instead of including $927, we're going to subtract the itemized deductions minus the standard deduction. And that means we only need to include $300 in income. See that here? Okay. Let's see. The last one we'll go over is our tax return. And then the last problem here is one of the Social Security problems, which was based on the examples I did in the lecture. So you might want to go back to that if you need help with that. So now we're going to just run through this tax return. We're adding a little bits to the tax returns as we go. So John and Martha are married, filing joint, 35 and 31, their address. Additional information about Mr. and Mrs. Holloway is as follows. So you need the Social Security number, right, to fill out the first page of Form 1040. These are their W-2s. So remember, for wages, you're going to need to add together both of their box 1 wages here. And then for federal payments made, you're going to add together their box 2 wages. Other than that, nothing else you're going to enter on this form. When we use tax prep software, you will enter all of this and they will check the Social Security and Medicare, but it's only rare circumstances where that needs to be addressed. Otherwise, it's a flat tax, so it's correct. So when we're filling out these forms, you're basically going to ignore all of those lines. We just need box 1 and box 2. Now we also have a Form 1099 DIV. Box 1A and 1B show 345 from Mar brokerage. So what should you do in that situation? Open a Form 1099 DIV to see what those 2 boxes are, or you could open your book, but I think it's good to get used to pulling stuff up online. And so here you can see 1A is ordinary dividends and 1B is qualified dividends. So that means that these dividends are qualified. And then 1099 INT shows these amounts. Box 1, 450 and box 4, 35. So Form 1099 INT. Box 1 is interest income, and box 4 is federal income tax withheld. So what are we going to do with this box 4 amount, this $35? This is going to get added in to our box 2s from their W-2s for working. They're all going to be payments made for the taxes. We'll go over the appropriate line in a second. So John is a maintenance worker. Martha is a human resource manager. So you'll put that on the forms. Prepare the tax return for them using the appropriate form. They want to contribute to the presidential election campaign. They had qualifying health coverage at all times during the year. So you'll check that box and list the taxpayers' names in the order in which they appear in the problem. You always use positive numbers, and then you can use the appropriate tax rates or tax tables, which it looks like they'll be in the tax tables because they'll be under 100,000. So here we check the married filing joint. We do John's information first, his social, then Martha here. Down here we enter their address. We check the box for health coverage. We check the box for both of them to contribute to the presidential campaign. No dependents. And that's all for page 1. Now we'll go to page 2. So box 1, this is where this 57,500, this is adding together their box 1 wages. And that goes on this line labeled wages, salaries, tips, etc., attached form W-2. Then we have tax exempt interest. So we have nothing in the tax exempt interest box, and then we have taxable interest here. So that's where we take our 1099 INT goes. Then down here we have line 3, qualified dividends and ordinary dividends. So we have the same amount in both boxes because we said box 1A and 1B had that 345. Then we scroll down, line 6 is adding these. We don't have any other schedules, so there's no schedule 1. We just add the total on line 6. And then line 7 is line 6 minus any deductions on schedule 1. So we have the same number coming down here. Standard or itemized, we have no itemized information, so we use a standard deduction for their filing status, MFJ, which you can find over here. And from there, you'll need to calculate on $34,295 the taxes, which is going to come out to, in this case, at $34,295, it's going to come out to $3,696. So we'll do that really quick. The tax tables, you just click here. I press Command or Control and then click just to make sure it opens in another tab. And so we're going to look at the married filing joint column for $34,295. So remember, at least the first column amount, but less than the second column. So if it is this amount, you go to the next line and find the amount of tax over here. Single married filing joint is our second column. So now we want $34,295. 34,295. So that falls in between 34,250 and 34,300. We're going to go to the second column, 3,732. 3,732. What do we have here? 34,295. 34,295. 34,295. Am I doing something wrong? They've got 3,696. Let's see what's happening. All right, so you should know what I was doing wrong. I was including our capital gains. Unfortunately, you can look at the table in the book or in my last video. They're in the 0% based on their total income, taxable income. They're in 0% capital gain rate. So all we need to do is take 34,295 and subtract 345, right? And that brings us to 33,950, which will put us right on a line. So see, 33,950. So do we use this row? No. We go to 33,950 down here, and we select the second column for married filing joint, 3,696. That's what we have over here for taxes. We put it here, then here, and then we have no other credits that they told us to use, so it gets carried down here. And then carried down again. And then on line 16, this is federal income tax withheld from forms W-2 and 1099. So like I said, you'll need to add together all of the withheld taxes from the W-2s, box 2, and the box 4 from 1099 INT. So you add all 3 of these together, and that is the amount that goes here for any W-2s withheld and any 1099s withheld. And then you subtract out the difference. And of course, in this case, we have a refund of $939. Okay, guys, that's all for our Chapter 7 problems set number 2. The tax return assignment will be like this one, so I won't have another video. But since we went through this line by line, you can practice on your own. And of course, you can submit it and get the feedback as well. All right. Let me know if you have questions. See you next time. Bye, guys.